What if I told you that the single most reliable predictor of a massive Bitcoin move has nothing to do with Elon Musk's tweets, the Fed's interest rates, or what some analyst on TV is screaming about? It's a quiet, mechanical, and brutally honest metric that just flashed its most alarming signal in over a year. And if you're trading with any amount of leverage right now, you are standing directly on the train tracks without hearing the whistle. I'm going to reveal the one chart that institutional traders guard with their lives, the one that's screaming squeeze right now. And by the end of this video, you will know exactly how to position yourself not just to survive the coming volatility, but to profit from it. So, do us both a favor, smash that like button and hit subscribe right now, because what I'm about to break down is going to change the way you look at the crypto markets forever, and you're going to want to have a front row seat for everything that follows. Let's be crystal clear about what we're actually seeing in the data, because most people look at a headline about funding rates declining and just scroll right past it, not understanding the absolute carnage that simple phrase represents. We're not talking about a gentle nudge or a minor statistical blip. We are witnessing a full-scale collapse in speculative conviction, a wholesale exodus from one side of the trade that create a powder keg of unrealized energy beneath the market. The raw numbers, sourced directly from Glassnode's on-chain data, are staggering. In mid-August, the traders holding long positions in Bitcoin perpetual contracts were paying a staggering $338 million per month to the traders holding short positions. Just let that sink in for a moment. That's $338 million being bled from the bulls to the bears, a massive financial incentive for people to bet against the rally, all because the longs were so overwhelmingly confident that higher prices were imminent that they were willing to pay this astronomical toll, this constant negative carry, just to keep their positions open. Fast forward to today, and that number has not just dipped, it has fallen off a cliff. That $338 million monthly funding payment has imploded by 62%, all the way down to a mere $127 million. This is not a market cooling off. This is a market going into cardiac arrest. This represents over $200 million of speculative premium vanishing from the ecosystem in a matter of weeks. Think of that money as the fuel that was feeding the bullish engine. That fuel tank is now running on fumes, and the engine is beginning to sputter. This is the most profound signal of a massive macroeconomic downtrend in speculative interest you can possibly find. The traders, the funds, the everyday people who are using leverage to amplify their bets are now throwing in the towel. They are no longer willing to pay the VIG, the interest, to maintain their bullish stance. This is a market equivalent of an army realizing its supply lines have been cut and starting a full-scale retreat. But here's the critical part that almost everyone misses. This funding rate mechanism exists for one reason, and one reason only: to tether the price of a perpetual contract, which has no expiration date, to the underlying spot price of Bitcoin. It's a clever bit of financial engineering designed to maintain equilibrium. When the market is irrationally exuberant, when longs far outnumber shorts, the funding rate turns positive, meaning the longs must pay the shorts. This payment acts as an incentive for more people to become shorts, selling a perpetual contract, which in turn brings its price back down toward the spot price. Conversely, when pessimism is rampant and shorts are overcrowded, the funding rate goes negative and the shorts have to pay the longs, encouraging buying. For months, we've been in a persistently positive funding rate environment, a clear sign that the market was leaning heavily and dangerously long. This massive decline in the dollar amount of these payments is the clearest possible evidence that this imbalance is being violently corrected. The longs are capitulating. They are closing their positions in droves because the price action has not rewarded their optimism, and the constant drain on their capital from these funding payments has become too much to bear. Every 8 hours, like clockwork, a portion of their potential profits was being siphoned away and handed to their ideological opponents, the shorts. This has now created a dramatically different and far more precarious market structure. The crowd is no longer leaning so heavily in one direction. The wall of worry is being climbed, but from the wrong side. This mass exodus from long leverage doesn't happen in a vacuum. It's a direct response to failed breakout attempts, strengthening macroeconomic headwinds, and a general sense of exhaustion that has permeated the bullish camp. The secret signal I'm talking about is this velocity of change. It's not just that funding rates are low. It's the sheer speed and force with which they have collapsed from such an elevated peak. This kind of move is a hallmark of a market that is rapidly deleveraging, shedding the weak hands, and setting the stage for a violent, decisive move that will catch the vast majority of retail traders completely off guard. The foundation is being laid for what could be the final shakeout before a major trend reversal, and understanding this dynamic is the key to your survival and success. Now, to truly understand the terrifying power of the situation we're in, you have to look past the dry statistics and see the real-world mechanics of a long squeeze in action, because what's brewing isn't just a simple price drop. It's a systematic, algorithmic unraveling of over-leveraged dreams, a financial domino effect that feeds on itself with brutal, computerized efficiency. The foundation for this cascade has been meticulously laid by the very funding rate collapse we just dissected, creating a market structure that is so precarious, so primed for a chain reaction, that it only needs one single spark to ignite the entire tinderbox. Imagine the market as a massive, multi-level building where every floor represents a different price point, and on each floor, there are thousands of traders who have taken out massive loans to buy Bitcoin, loans that are secured only by the value of their Bitcoin itself. These are your leveraged longs, the people using 5x, 10x, 50x, even 100x leverage, amplifying their gains but also building their financial house on a foundation of quicksand. Their entire existence is predicated on one simple, dangerous assumption, that the price will only go up, and it will do so without any significant interruptions or pullbacks. The moment the price stops going up, the moment it even hesitates or wavers, the entire structure begins to groan under its own weight. As the price starts to dip, even just a few percentage points, the value of their collateral decreases, and exchange's risk engine immediately takes notice. They get the first polite warning, a margin call. It's a notification that their equity, their buffer, is getting thin, and they need to deposit more money, more collateral, to support their increasingly risky position. But here's the brutal truth. Most of these traders are already all in. They've committed every dollar they were willing to risk, driven by the fear of missing out on the next leg up. They have no more capital to add. So they do nothing, hoping for a miracle, praying for a sudden green candle that will save them. But the market doesn't answer prayers. It follows physics. And in this case, the physics are dictated by lines of code in the exchange's liquidation engine. When their collateral value falls below a specific, predetermined threshold, the exchange's automated system steps in with zero emotion and zero mercy. To protect itself from taking a loss on the loan it effectively provided through leverage, the exchange forcibly closes the trader's position. It sells their Bitcoin for them, right then and there, into the open market. This is the first domino. This initial, automated selling from the first wave of liquidations adds sell-side pressure to the order book. It's not a human deciding to sell out of fear. It's a computer executing a sell order without any regard for price, time, or sentiment. This selling pushes the price down a little further. Now, remember that multi-level building? The price has just dropped to the next floor down. And on this new floor, there's another, even larger cohort of leveraged longs who were previously safe, who were watching the price dip from a comfortable distance. But now, with this new lower price, their positions are suddenly underwater. Their collateral is now insufficient. Their margin call alerts light up, and for them, too, it's often too late. The liquidation engine claims them as well, triggering another, larger wave of automated selling. This selling pushes the price down even further, onto the next floor, where an even larger group of longs is waiting, terrified, watching the price approach their liquidation level. This is a cascade. This is a self-reinforcing feedback loop of doom. It's a vicious cycle where liquidations beget more liquidations, where automated selling drives the price down, triggering more automated selling. This is why a long squeeze can cause a price to drop 10, 15, even 20% in a matter of minutes. It's not a fundamental reevaluation of Bitcoin's worth. It's a purely technical, mechanical unraveling of excessive leverage. The compressed, collapsing funding rates we discussed are the proof that the first, silent phase of this process is already complete. The smart money saw those elevated funding rates as a giant, flashing invitation to take the other side of the trade. They became the shorts, patiently sitting in their positions, collecting that $127 million in funding payments from the hopeful longs, effectively being paid to wait for this exact moment. They provide the initial liquidity for the early longs to exit, but it's a trapdoor. And the one chart that predicts this entire catastrophe isn't just a funding rate chart alone. It's the funding rate chart layered directly over the estimated liquidation heat map, a tool that aggregates data from all major exchanges to show where these clusters of leveraged positions are sitting. When you see funding rates compress violently from an extreme high, while the price is hovering nervously just above a massive, dense cluster of long liquidations, sometimes representing billions of dollars in notional value, you're looking at the kill zone. You can literally see the price meandering above a valley of financial ruin, a cliff face of liquidations just a few percent below. Any catalyst, a negative CPI report, a sudden crash in the S&P 500, a worrisome headline about a major exchange, or even just one large manual sell order from a whale can be the pin that pops this bubble of leverage. The market doesn't need a fundamentally good reason to rally or a fundamentally bad reason crash. It only needs the right conditions. And right now, the conditions for a historic long squeeze are not just present. They're being loudly advertised by the most honest data source we have, the blockchain itself. This is a calm before the storm, the moment of maximum tension where the entire market holds its breath, waiting to see if the last line of defense, the spot buyers, can hold the line against the coming algorithmic tsunami. So the squeeze happens. The cascade of liquidations rips through the market. The price plummets in a terrifying blaze of red candles and panic. And then what? This is the moment that separates the amateur from the professional. The moment where true fortunes are built from the ashes of other people's despair. Because the aftermath of a long squeeze is not an endpoint. It's a critical reset, a cleansing fire that burns away the weak and unstable structures to make room for something far more solid and sustainable. The emotional and financial devastation of the squeeze creates a narrative of pure fear, a story that the media will gleefully amplify with headlines screaming about a crypto crash and a broken thesis. But buried beneath that layer of panic are the very seeds of the next major bull run, and knowing how to spot them is your single greatest advantage. Think of the market after a major long squeeze as a forest after a controlled burn. The fire is terrifying and destructive in the moment. It consumes everything in its path. But what it leaves behind is a nutrient-rich layer of ash and a landscape cleared of dense, combustible underbrush, allowing sunlight to reach the forest floor and new, healthier, and stronger saplings to take root and thrive. In market terms, the underbrush is that massive overhang of weak, over-leveraged long positions. When they are forcibly liquidated, their collateral is sold, and they are wiped out of the market entirely. They are the fuel for the fire. But in every single trade, for every seller, there is a buyer. Someone is on the other side of those liquidation sales, purchasing those bitcoins that are being dumped onto the market by the automated engine. Who is it? It's not the panicked retail trader. They're the ones being sold out. It's the deep-pocketed, patient, and disciplined players, the sovereign wealth funds, the family offices, the hedge funds, and the experienced whales who have been waiting in cash or stablecoin for exactly this moment of maximum fear. They are the ones who are perhaps even short, profiting handsomely from the decline itself, and who now have even more dry powder to deploy. They step in not to catch the falling knife at the very first sign of a drop, but to buy methodically and relentlessly once the liquidation cascade shows signs of exhaustion. This is the ultimate wealth transfer mechanism in crypto. Assets are systematically moved from the impatient, emotional, and over-leveraged to the patient, disciplined, and liquid. The entire market structure undergoes a profound and healthy transformation in the wake of a squeeze. The aggregate open interest, which had ballooned to dangerous levels during the peak of the speculative frenzy, collapses dramatically. This is a fantastic thing. Open interest represents the total number of outstanding derivative contracts, and when it plummets, it means that leverage has been purged from the system. The market becomes leaner, meaner, and significantly less fragile. There are simply far fewer leverage longs left to liquidate on the next down move, which means the market becomes inherently more stable and less prone to these violent, cascading crashes. Simultaneously, the funding rates, which were so dangerously positive, reset completely. They don't just go to zero, they often plunge deep into negative territory. This is a crucial psychological shift. Negative funding rates mean the shorts, who were just collecting payments and making money on the way down, are now the ones who have to pay the longs. This acts as a powerful disincentive to keep shorting and a compelling incentive to start closing those profitable short positions and flip long. This is a great flip that signals a potential trend change. The market sentiment, which was overwhelmingly greedy at the top, is now overwhelmingly fearful, even capitulatory. This is where you see the classic signs of seller exhaustion on the lower time frame charts. The volume starts to decline on the down moves. The rallies become sharper and more aggressive, and most tellingly, you start to see bullish divergences on momentum indicators like the relative strength index, where the price makes a new low, but the RSI makes a higher low, indicating that the downward momentum is waning even as the fear reaches a crescendo. This is a point of maximum financial opportunity, the moment where the risk-to-reward ratio is so heavily skewed in your favor that it demands action. The smart money isn't buying because they know the price will never go lower. They're buying because they know that the combination of purge leverage, reset funding rates, and peak pessimism creates an asymmetrical betting opportunity. They are accumulating a long-term position with the understanding that the fundamental thesis for Bitcoin hasn't changed. If anything, the macroeconomic conditions that gave rise to it are strengthening, but the price has become disconnected from that reality due to a purely technical, leverage-induced breakdown. This new uptrend, when it finally begins, is not built on the same shaky foundation of excessive leverage and reckless speculation. It is built on a foundation of real, spot-driven buying from investors who believe in the long-term store of value proposition, from institutions adding it to their balance sheets as a non-correlated asset, and from a derivatives market that has been reset to a healthy, neutral state. The squeeze, as painful as it is the necessary medicine for a sick market. It is a violent, chaotic, but essential process that clears the path for genuine, sustainable growth. And recognizing this pattern is what allows you to be a builder in the ashes when everyone else is still running from flames. Now that you understand the anatomy of the squeeze and the profound opportunity in its aftermath, it's time to translate this knowledge into a concrete, actionable game plan, a step-by-step strategy that will guide you from being a potential victim of this volatility to becoming its master. This isn't about making a single lucky trade. It's about implementing a systematic approach to risk and opportunity that will serve you for the entirety of this market cycle and beyond. The first and most critical rule, the one that must be etched into your mind before you even consider opening a trading terminal, is the absolute, non-negotiable commandment of leverage management. The entire horror story we've just detailed was caused by one thing and one thing only: excessive leverage. Your primary defense is to use little of it, or better yet, none at all in your core, long-term spot position. Leverage is a tool, not a strategy. It's a double-edged sword that most people use to accidentally stab themselves. The traders who get wiped out in the squeeze are not unlucky. They are undisciplined. They are the ones who believe they could outsmart the market's inherent randomness with borrowed money. Your goal is not to be them. Your goal is to be the patient capital on the sidelines, the one who buys the assets they are forced to sell. This means that if you're currently in a highly leveraged long position, especially one that is already feeling the pressure of a declining market, your number one priority right now is to deleverage. Take profit if you have any, or cut your loss before the liquidation engine does it for you at the worst possible price. Preserving your capital is not a loss. It is a strategic victory that grants you the optionality to play another day when the odds are dramatically more in your favor. The second pillar of the strategy is active monitoring of the very metrics we've been discussing. You don't need to stare at charts all day, but you must develop a routine of checking the key vitals. Bookmark the Glassnode charts for Bitcoin funding rates, both in percentage and in dollar terms. Make it a habit to look at the liquidation heat maps on platforms like Highblock or CoinGlass. You are looking for the specific setup we outlined. Funding rates that are compressed aggressively from elevated levels, coupled with price that is coiling just above a significant cluster of long liquidations. This is your early warning system. This is a secret signal that tells you to raise your defenses, to move a larger portion of your portfolio into stablecoins, and to get ready. Conversely, your signal to go on the offensive, to start deploying that dry powder, is not when the price starts rocketing back up. It's when the liquidation cascade has clearly run its course. You look for those signs of seller exhaustion, A final, massive red candle on huge volume, followed by a strong, high-volume green candle that reclaims a key level, a bullish divergence on the RSI. And most importantly, a stabilization and eventual normalization of the funding rates. This is when you start buying spot Bitcoin in tranches. Never go all in at once. You scale into your position, buying a little at what you believe is the bottom, and then more if the price goes lower. This dollar cost averaging approach in the midst of panic ensures you don't try to pinpoint the absolute bottom, but instead build a position at a fantastic average cost basis. The third pillar is psychological fortitude. Executing this plan sounds simple on paper, but it is emotionally grueling. Buying when headlines are screaming about the death of Bitcoin in your social media feed is a wall of despair requires immense courage and conviction. Selling into strength and taking profits when everyone is greedy and predicting endless new all-time highs requires a discipline that goes against our most basic human instincts of fear and greed. This is why you must have your plan written down in advance. Your trading plan is your constitution in the chaotic democracy of the market. It is a set of rules you fall back on when your emotions are screaming at you to do the wrong thing. Decide now, before the next squeeze hits, what your criteria are for selling, for buying, and for holding. What percentage drop will trigger you to start buying? What funding rate threshold will tell you to take profits on a long position? Write it down and swear an oath to yourself that you will follow it. The market is designed to exploit your psychological weaknesses. A solid plan is your armor against that manipulation. Finally, remember that this is a cycle. These squeezes and their subsequent recoveries are not random one-off events. They're the fundamental heartbeat of a volatile, maturing asset class. They will happen again and again. Your mission is not to predict every single twist and turn, but to understand the underlying mechanics so well that you can position yourself to win the war, without needing to win every single battle. By mastering the interplay between leverage, funding rates, and market structure, you graduate from being a passive passenger to being the pilot of your own financial future. You stop being the fuel for the fire and start being the one who controls the flame. So, if this deep dive has fundamentally changed your perspective on how these markets truly operate, if you now see the liquidation levels and funding rate data as your most powerful map and compass, then I need you to do something for me right now. Go down into the comments section and type, "The squeeze is on." This lets me know you're understanding the gravity of this signal. And then smash that subscribe button and ring the notification bell, because we are not done here. In my next video, I'm going to break down the single most accurate on-chain metric for timing the exact bottom after a squeeze, a metric that's called every major cycle low with stunning accuracy. You are not going to want to miss it. This is your wake-up call. The great Bitcoin squeeze is finally here, and now you have the playbook.